Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
Okay, so February 11th, 2026, Sidus Space, ticker SIDU. The stock closed the session at $2.24, and the volume was significant. We're talking 5.98 million shares changing hands. But the price action itself was, well, it was heavy. It slid 5.49% on the day. That puts the market cap right around $160.98 million.
And if you just pull back a little bit, that $2.24 price tag is sitting inside a 52-week range that is enough to give anyone motion sickness. I mean, we've got a low of 63 cents and a high of $5.39. That is just extreme volatility. We saw the stock go absolutely, nuclear in January. And what we're seeing now is the inevitable cooling period. Gravity is kicking in.
Gravity is certainly one way to describe it. But I think we need to figure out if what we're seeing is a correction or a collapse. So the central question for today is whether this volatility is just noise masking a fundamental structural shift in the company. Is Sidus Space a transformative new space infrastructure play that's poised for, say, a five-fold re-rating? Or, and I suspect this is where you land, is this a capital-intensive cash incinerator that's just going to trap investors in a cycle of dilution?
Oh, it's the latter, no question. When I look at these numbers, I don't see a structural shift. I see a company where revenue is falling, the cash burn is alarmingly high, and you have this massive shelf registration hanging over the stock like a guillotine. I call it the dilution paradox. They need money to grow, sure, but raising that money absolutely destroys shareholder value. It's a trap.
I see why you'd frame it that way. I do, especially if you just glance at the headline numbers. But let me give you a different perspective here. You're looking at a snapshot of where they were, not where they are going. This is a classic strategic pivot. They're moving from low-margin manufacturing, bending metal for other people, to high-margin space as a service. They aren't just building boxes anymore. They are putting data centers in orbit. So let's dig into the position statements. I want to start with your claim about the falling revenue, because I think the market is completely misinterpreting that 27% drop we saw in the 9 months ending September 30, 2025.
A 27% drop to $2.8 million. Okay, I'm listening. Tell me how a contraction is actually an expansion.
Because it's a deliberate contraction. They are shedding legacy low-margin manufacturing contracts. They're clearing the deck. I mean, if you're building a low-margin widget for a third party, that takes up floor space, it takes up man-hours, and it returns very little to the bottom line. Sidus is stopping that to focus on being vertically integrated. They're 3D printing their own satellites, the LizzieSats. And this isn't a PowerPoint presentation or some rendering. This is hardware in the void. LizzieSat 1, or Thelma, and LizzieSat 2, Lauren, are operational. And significantly, LizzieSat 3, Eileen, was commissioned just this past December in 2025.
Just a few months ago.
Exactly. That's a proof of concept that is actually working. LS3 is already generating maritime data via AIS payloads. That's the automatic identification system for tracking ships. So they have proved the bus, the satellite body, it works. The pivot is real.
Okay, I'm not denying the satellites are up there. My issue is the cost of getting them there. A pivot is only real when it pays the bills. Until then, it's a gamble. My position is based on the cold, hard reality of the balance sheet. You can talk about shedding legacy contracts all you want, but you still have overhead, you still have salaries, and over that same 9-month period where revenue dropped, they posted a net loss of over $18 million.
Innovation is capital intensive, you know this. You can't build a constellation for free.
Well, there's capital intensive, and then there's precarious. Look at the cash position. As of the end of Q3 2025, they had $12.7 million in cash. But their operating cash outflow was over $14 million. You don't need a PhD in economics to see the problem there. They're burning more cash than they have on hand in a standard operating cycle. And this brings me to the elephant in the room. The thing that I think makes this uninvestable for a serious long-term holder right now, the dilution paradox. On January 20, 2026, they filed a mixed shelf registration for $500 million.
Which is standard operating procedure for a growth company. It ensures access to capital so they don't get squeezed.
Standard? It's more than triple their current market cap. The company is worth $160 million, and they've filed to potentially sell $500 million worth of paper. This creates a persistent overhang on the stock price. Every time the stock rallies, like we saw in late January, the company is incentivized, perhaps even forced, to sell shares into that strength just to keep the lights on. It caps the upside. If the stock goes up, they dilute you. If the stock goes down, they have to dilute you even more to raise the same amount of money. It's a death spiral waiting to happen.
I think death spiral is a bit hyperbolic. You're viewing the shelf registration as a threat. I view it as a war chest. And why do they need that chest? Because the opportunity in front of them is massive. And let's move into the core debate, because we need to talk about the defense angle. This is where the bear case really falls apart for me. We're talking about the MDSH IDIQ award announced on December 22nd, 2025.
I knew you were going to bring up the IDIQ.
How can I not? It's a contract vehicle with a ceiling of $151 billion over 10 years. Sidus Space, a micro-cap company, is now an awardee on a $151 billion vehicle. This is the Golden Dome missile defense strategy. The Department of Defense is looking for resilient, multi-domain defense layers. They need expendable, responsive satellites. Sidus is now in the room with the prime contractors. Even if they capture a fraction of that ceiling, it is transformational revenue for a company this size.
Right, that's a compelling narrative, and I know retail investors love that $151 billion number. But we need to be very precise about what an IDIQ actually is. It stands for Indefinite Delivery, Indefinite Quantity. In the industry, we call this a hunting license. It is not a check. It is not a purchase order. It simply means Sidus is allowed to bid on task orders against other awardees. And who are those awardees? Usually the titans of the industry, Lockheed, Northrop, Raytheon. There is no guaranteed dollar amount attached to this.
But being on the vehicle is the hurdle. You can't even bid if you aren't on the list. Once you're on it, the acquisition process is agile. It's faster.
Faster, maybe, but not guaranteed. And let's look at the macro picture here. Government budgets fluctuate. Geopolitical priorities shift. Relying on a slice of a $151 billion pie that you have to fight for, tooth and nail, against entrenched competitors, it's speculative. You cannot bank that revenue. It's a lottery ticket, not a business model. You're celebrating the permission to compete, not the victory of winning.
I disagree. It's validation. It proves their technology meets the rigorous standards of the Missile Defense Agency. And speaking of technology, that's the other catalyst you're ignoring. The market is starting to understand that Sidus isn't just a metal bender making boxes. They are an edge computing company.
Edge computing is a buzzword that gets thrown around a lot. I mean, every company with a microchip claims they're doing edge computing.
In this case, it's real. Look at the partnership with Sense announced on February 10, just a couple of days ago. They're integrating hyperspectral imaging, and then you have the Maristech partnership for AI video. But here's the key. They are processing that data on the satellite using their FeatherEdge hardware and the Orlif AI platform.
Why does that matter to the bottom line? Why shouldn't they just beam the pictures down like everyone else?
Because of latency and bandwidth. I mean, traditionally, you take a picture, you store it, you wait 45 minutes to pass over a ground station, you download a massive raw file, and then you process it on Earth. That takes time. In a defense scenario or a disaster response scenario, that time is too long. Sidus is processing the data in orbit and just sending down the answer. Is there a ship here? Yes or no. Is this crop stressed? Yes or no. This is the Netscape moment for orbital compute. They're effectively moving data centers to space. That is a high-margin, high-value service.
I come at it from a different way. The tech is fascinating, I'll grant you that. Hyperspectral imaging, seeing the chemical composition of things from space, is valuable. But let's talk about execution risk. You mentioned the Maristech integration and the Simera partnership. Those are for LizzieSat-4 and LizzieSat-5.
Correct.
Okay, well, those satellites are only slated for launch in late 2026. We are in February. Late 2026 is a long time for a cash-burning startup to wait for its next generation of revenue drivers. They have to survive 10 more months of burn before that hardware even leaves the ground. And frankly, look at the competition. You have Planet Labs, ticker PL. They've got a $4.7 billion market cap, a massive historical archive of data, and they scan the whole Earth every day. You have BlackSky, BKSY, which is deeply entrenched in intelligence and defense. Sidus is trying to compete with these giants while running negative gross margins. In Q3 2025, their gross loss was $1.3 million. They aren't just losing money on overhead, they're losing money on the actual service delivery right now.
That's a temporary condition of the pivot, and you're comparing apples to oranges. Planet Labs sells data. They're a data company. Sidus sells the bus and the service. It's a modular business model. If you want to fly your own sensor, Sidus will host it. If you want to buy data from their sensor, they'll sell it. It's hybrid, it's more flexible, and that flexibility is why I think the 10-year horizon is so interesting.
I'm skeptical of any 10-year projection for a company with less than a year of cash runway, but walk me through the math.
Okay, so let's look at the 5x potential. To get a 5x return from here, Sidus needs to reach a valuation of roughly $800 million. If you run the CAGR, the compound annual growth rate, that requires about a 17.46% annual growth in value. Now look at the macro. The global space economy is projected to reach $1.8 trillion by 2035.
A rising tide lifts all boats, sure, but some boats have holes in them.
Let me finish the math. To justify an $800 million valuation in 2035, applying a standard industry multiple of about 8x sales, Sidus only needs to generate about $100 million in annual revenue, just $100 million, by 2035. If the LizzieSat constellation scales as planned, if they convert even a tiny percentage of that defense backlog, that number is conservative. This is highly attainable.
The math works if, and it is a massive if, the company survives without wiping out current shareholders. You mentioned the January 23rd rally, where the stock jumped 15.55% on $45 million in volume. You see that as market validation. I see it as a warning sign of volatility. Short interest is sitting at 12.44%. Analysts have sell ratings on the stock.
Analysts are often behind the curve on paradigm shifts. They model based on historical data, not future capabilities.
Or they're looking at the balance sheet. If the stock drops, raising capital becomes harder. It triggers what we call a death spiral. Let's explain that mechanic. If the stock is at $2, they have to sell X number of shares to raise $1 million. If it drops to $1, they have to sell 2X shares to raise that same million. That dilutes you twice as fast, which drops the price more, which forces them to sell even more shares. It's a vicious cycle.
But the volume tells me the market wants to fund this. The SpaceX halo effect is real. As the big players make space accessible, the infrastructure providers like Sidus, who build the roads and the gas stations of orbit, are going to get bid up. The market is looking for the next breakout, and Sidus has the hardware in space to prove they're a contender.
Look, I appreciate the vision, I really do. The idea of 3D printing satellites and running AI on them in orbit it's the stuff of science fiction becoming reality. But as an investor, I cannot look past the financial footing. It's just too slippery. You have a dependency on equity sales to fund a burn rate that isn't slowing down fast enough, and that creates a fundamental conflict of interest between the company's survival and the shareholders' equity. The management team needs to sell shares to keep the lights on. That means your shares get less valuable. That $500 million shelf registration isn't just a number. It's a signal that they know they need massive amounts of capital to get to that 2035 vision.
I see that risk, but I view it as the price of admission for a classic inflection point. The shift to recurring revenue is painful. It always looks like this. Margins look terrible right before they look great. Revenue drops right before it spikes. They have 3 satellites in orbit. They have a partnership with Lawnstar for lunar data storage, which puts them in the cislunar economy, by the way. And they have a foot in the door at the MDA. The pieces are there for massive re-rating. It is absolutely a high-risk play, but it is a high-reward play on the infrastructure of the future.
It just comes down to timeline and risk tolerance. If you're trading the daily volatility, well, good luck. The swings are wild. But if you're investing for 2035, you have to ask yourself if Sidus can bridge that gap between promising tech and profitable business before they dilute you into irrelevance.
And I would argue that if you believe in the orbital economy, you have to own the infrastructure. Sidus is building it. The volatility is just the price you pay for the ticket.
Well, we've laid up the numbers, the contracts, and the risks. The choice, as always, is yours.
Exactly. Whether you see a cash furnace or a rocket ship depends on your horizon. Thanks for listening to the debate.
Until next time.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.